Welcome to the Edified Equity Podcast. My name is Dino, CEO of Edified Equity. Here we focus on all of the unique benefits associated with being a passive equity investor in an apartment syndication. You can learn more about us on the web, iTunes, Stitcher, BiggerPockets, Facebook, and YouTube. I will have all of the links posted in the comments and show notes. Today I'm coming to you to discuss briefly deal or no deal and what qualifies as a deal. Now, everyone has their own definition of what qualifies as a deal. So what's important for you to decide on and have a clear understanding of is, what's a deal mean to you as a passive equity investor when operators are bringing you deals to analyze? You need to have defining lines of what is and what isn't a deal. And today I'm going to share with you what we look for in a deal. And these rules don't have to be set in stone. In other words, I'm encouraging you to be negotiable. If you're saying I need X% cash on cash and they are projecting a 0.5% less than what you really want, and deals are really hard to come by these days, you like this team, you like the business plan, you like the opportunity, I'm not saying to say no to that just because it's slightly below what you want. I'm just saying you have to have some type of guide to go off of so that you can quickly identify what is and isn't a deal. Because when deal flow starts coming your way, and when you learn about this alternative investment and say, this is right for me, I'd much rather this opportunity than to have my money in the stock market, a mutual fund, a bond, sitting in the 401k, IRA, the bank, buried in the backyard, wherever your money currently is. So you have to have a way to quickly identify what is and isn't a deal and filter these out so that you're not spending a ton of time and energy on things that don't fit your criteria. So main focus, I want to talk about what we look for in a deal. Because when we network with brokers are a key team player. As far as our team goes, we really rely heavily on them to bring opportunity to the forefront. We have great relations with them. We get to see deals before other operators get to see deals because they know that we're real. They know that we can close, and they know what our criteria is. So we even educate them so they don't bring us everything under the sun. They say, okay, this is the areas they want, these are the types of returns they're looking for, and things like that. We focus on cash flowing, light to moderate value add with some upside opportunity. So we don't buy anything that isn't cash flowing from day one. We have equity investors that are part of this syndication, and we need to give them a return on their money. Now, it might be a little lower in the first 1 or 2 years, maybe 1, 2, or 3 years, while we're doing what we need to do, while we have the business plan in place, and we're adding that value, we're forcing appreciation, and we're improving and increasing the net operating income. But they understand that, and what they're going to look at is the average cash on cash over the life of the investment. However, we do want some type of cash on cash return starting from day one. So we don't buy, for example, a vacant building. It has to be cash flowing, and then we come in and improve operations, and we add the value there. We look for B and C class multifamily, of course, apartment communities. Purchase price $1.3 million, as high as $30 million, and we may increase that. I've been talking with investors, and things have been coming across my desk where, hey, we have maybe up to $400 million to put to work and things like that. So right now, that's our guideline, 1.3 to 30 million, and that's what we're underwrite, and that's what we look for mostly. Our target markets are simply the Midwest and the South. Again, be negotiable. If a great opportunity comes to the forefront and it's not in the Midwest or the South, it doesn't mean we won't underwrite it. It just means the Midwest and the South is where we already have teams set up. We have management in place. We already own property in those areas. We like it. We know it. We understand the market. So Midwest and the South, have a geographical area. Now, I live in Colorado, and we're looking at opportunities in Alabama, we're looking at opportunity in Tennessee, looking at opportunity in Chicago. I'm not geographically constrained to where I live because we have teams and partners set up. So I have a little saying, live where you love, invest where it makes sense. So have a geographic, have a target market. The size, we like 50 at a minimum or more, and the more the merrier for many reasons. Number one is the more doors you have under one roof, the more sense it makes to tap into professional third-party management. We manage our managers, but we don't actually do the physical management ourselves. So we rely on best-in-class management company for the asset class and the area that we're looking at. And the more doors we have, the easier it is for us to have that expense written into our underwriting. Plus, we want to leverage economies of scale. We want a management company that's going to be able to handle turnover. We want a management company that has relationships in the area so that they can get supplies at a very discounted, quality supplies at a discounted rate. Some of the other reasons is time. And what we found is it doesn't take much more time to look at a 500 unit complex versus a 50 unit. We're still spending the time and the energy on ourselves and the associated professionals when we have a larger unit. So it makes sense, again, going back to economies of scale. And the more units you have, the easier it is to handle vacancy. If I have a single family home for rent and I have one renter, I'm 100% occupied. But if they vacate overnight, I'm 100% vacant. If I have 50 to 500 units and one person leaves, it really isn't going to have that much of an impact overall on the net operating income. Plus, we underwrite conservatively for vacancy. And I talked about management. There's more reasons, but basically we look for 50 or more. We do look for the opportunity to improve operations and add value. So we're looking for something that might have below market rent. Maybe it was a mom and pop owner. They know all the tenants. They haven't increased the rent in, 1, 2, 3, 5, 10 years. So maybe it's a little mismanaged and in need of renovations, and or the vacancy is undesirable. Maybe they're 15% vacant in a market that really should be 5% vacant. So this gives us the opportunity to come in and improve operations and add the value. As far as location goes, we want an emerging market. We're looking for areas that are in the path of progress and they're rapidly improving. So it might be the submarket of a major city, and because of the growth that's happening there, the submarket is also experiencing that growth, and we can tap into something that's less pricey, but gives people the opportunity to travel into the major city for work, travel into the major city for recreation, and basically say they still live in that city because it's just right on the outside of the submarket. We're looking for an MSA of 250,000 or more and growing. So again, we want it to be growth, but we also want people to already be living there. So it's proven that it's a strong submarket. And what this does is it gives us the opportunity to provide that undervalued asset and allows us to force appreciation quickly within the first 1 to 3 years so that we can really boost the returns. We can boost the value of the property, and planning for a quick liquidity event in maybe year 5, where we can give most of the money back to the equity partners and continue to stay in that deal, boosting the cash on cash return for maybe, for example, another 5 years. Cap rates. So this is something that is kind of a controversial topic, but we look initially, again, not everything's negotiable here, but initially on actuals. So not in the offering memorandum that the broker provides us, but on the actuals. When we dig deep, when we start doing our paper due diligence, we want to see a 6 to an 8% or more cap rate on actuals. But depending on the location, the amount of value add and upside available, a lower cap rate could be acceptable. And I've talked with other operators who they see the same thing. Unfortunately, some people just get caught up in, I only want a 10 cap. Okay, well that's nice. You're going to get a really nice cash-on-cash return, but those might be few and far between these days. And what we like to look at is we're less interested in what the current operators have been able to do because maybe they've taken their eye off the ball. We won't do that. We take our business seriously and we want to add value. We want to have an impact investment. And we definitely want to give a solid return to our equity partners. So what we say is if I'm looking at a deal and I say, well, this is a 4 cap, for example, but it's not a 4 cap because it's compressed and it's a true turnkey where we come in and there's really nothing more for us to do. All the renovations have been done. They have occupancy, as high as can be, and there's just not much for us to do here. This is the most we're going to get for our money. That deal might not work. But if I'm looking at a 4 cap because there's a ton of vacancy, the rents are below market, there's a lot of value add, I might say I'm less interested in what these people have done and more interested in knowing what we can do and what our management team can do because we know this area. We already own 100 units right up the road, and this is the track record we have. We know we can do the same thing with this building. So I don't get too stuck on cap rate, but we have this defining rule which allows us to analyze quickly. We're looking for a minimum 6 or more on the actuals. Again, lower could fit. We just have to really dig deep in and analyze. So after stabilization, we're looking for a solid cash-on-cash return for our equity owners. Stabilization should happen within the first 1 to 3 years, depending on how much work and where the leases are going to turn over and things like that, but how much operational improvement that we can come to the table with. We prefer a deal that will qualify for agency financing. So we're looking for Freddie, Fannie, and HUD type of financing. However, having said that, if it's a really good opportunity and the price per door just makes sense all day long, we can purchase something and bridge into traditional financing through an agency maybe within that first 2 to 3 years. So we like it, again, to be what we'll say bankable up front, but it's not dead set if it makes sense and we have the equity backing, we have a track record in that area, and we know we can perform, we can say yes initially. So those are just a few key criteria that we look for when analyzing a deal. And what it allows us to do as brokers bring opportunity to the forefront. We can quickly look at it and say, okay, does it hit everything that we're looking for? Does it hit, 8 of the 10 things that we're looking for? But it allows us to analyze quickly. Otherwise, you can get really overwhelmed with deal flow super quick because they'll send you everything under the sun, especially when they know you can close and they know you're a real player in the game. I hope you enjoyed this content. Whether you're here for education, whether you're here for the entertainment, or you or someone you know wants to learn more about this alternative investment, please help them by sharing this information. I don't have anything to sell you, but I am on a mission, and that mission is to continue to provide quality, educational, consultative content on a routine basis. Thanks for tuning in. Make it a great day. You certainly deserve it. To your wealth, I'll be in touch soon. Signing out.